You get paid on Friday. Direct deposit $2,847 after tax. You check the app. You feel it that brief. Fullness that arrives every 2 weeks and lasts about as long as a cup of coffee staying warm. By Monday, $1,190 is already gone. Rent, auto pay, subscription, transfers you set up so you would not have to think about them. You don't think about them. By the following Friday, you have $340 left. You are not sure where the rest went. Not exactly. You know the category, you just can't feel them anymore. You are not spending recklessly. You are not lazy. You are not irresponsible. You are working a full-time job while 4 invisible forces work a full-time job on your money and nobody told you their names. This is not video about budget. You have seen those, the spreadsheets, the envelope method, the no spread challenge, cut the coffee, cancel the subscription, stop eating out. This is about what happens before any of that. What's happening right now, tonight, while you sleep, to the money you earned, the money you saved, the money you thought was safe, sitting in an account with your name on it. There are 4 of them. They don't announce themselves. They don't send a bill. They work purely, consistently, and they have been working since the first paycheck out you have deposited. Let's go through them one by one. The first, forced inflation. It does not take your money, it shrinks what your money can do. In 2020, you could fill a grocery cart for $120. The same cart, the same item in 2024 costs you closer to $165. You do not buy more. You do not buy better. You bought the same thing and it costs you $45 more. That's not bad luck. That's inflation. The Bureau of Labor Statistics tracks it through something called the Consumer Price Index. Between 2020 and 2024, cumulative inflation ran over 20%. That means $1,000 sitting in your account in January 2020 has the purchasing power of roughly $830 today. You do not lose the dollar. You still have 1,000 of them. You lost what they could buy. This matters most for the money you are not investing. The $2,000 emergency fund that's been sitting in a checking account for 3 years. The $5,000 you are holding while you figure out what to do with it. The money that feels safe because the number on the screen has not changed. The number has not changed. Everything the number measures has. A saving account paying 0.5% annual interest against 4% inflation is not saving your money. It's losing it at a controlled, polite rate that does not feel like losing. The first rule, money that is not moving is moving backward. You just can't see the direction it's going. The second, force fees. They are small, they are constant, they are designed to be invisible. Open a bank statement, note the summary, the full statement, find the lines item, monthly maintenance fees, $12, out of network ATM, $3 twice, wire transfer, paper statement, insufficient fund, overdraft protection, account below minimum balance. None of this. That's the point. $3.50 doesn't feel like a theft. $12 doesn't feel like a decision, but $12 a month is $144 a year. Over 10 years, that's $1,440 before compounding. If that $144 annual fees invested at a 7% return, it's compound to roughly $2,000 over that decade. You paid $2,000 for the privilege of keeping your money in a building. That's just banking fees, not open your $400,000. Find the expenses ratio. It is a small number of 0.5%. 1% sometimes 1.5%. It doesn't like fees. It doesn't bill you. It just removes from your returns every year. Research has shown that a 1% annual fee difference on a retirement account compounded over these years can reduce of your final balance by more than 25% retirement. Go not to a bad decision, to a number after a decimal point that you never thought to read. The final industry regulatory authority has tools that lets you calculate this. Most people never use them. Most people have never heard of them. The second rule, fees are precise to feel irrelevant. They are designed to be paid without being noticed. The individual cost is always the most expensive one. The third, forced taxes. Not the ones you file, the ones you forget about. You know, income tax. You see it on a pay stub. It is visible, legible, already processed before you touch the money. But there are others. Every time you sell an investment you held for less than a year, the gain is taxed as ordinary income. Depending on your bracket, that could be 22%, 24%, even 30%. You made $800 on a stock. You kept $550. The rest went somewhere you did not choose. Social Security and Medicare take 7.65% from every paycheck before any others. Calculation, your employer matches, but that match comes from a budget that would otherwise be your salary. You pay 15.3% of every dollar you earn before you see it. Sales tax, property tax, break it to rent, capital gain tax, estate tax, dividend tax. The average American pays an effective tax rate when you include all forms of taxation sits between 50% and 20% of income. For every dollar you earn, you keep 65 to 75 cents. The rest move immediately before the coffee, before the rent, before the grocery cart. This is not agreement about whether taxes are right or wrong. This is just what happening. Tax advantage accounts. System decided these vehicles would let you keep more of what compounds. Most people know that exists. For fewer understand exactly which one to use, in which order, in which situations. That gaps cost money that does not announce itself as a cost. The third rules, the tax code rewards people who understand it and charges extra from those who do not understanding. It is not optional. It is difference between building something and running in place. The fourth force, opportunity cost, the money you did not lose, the money you never made. This one is the hardest to see because it does not appear anywhere. No line on a statement, no withdrawal confirmations, just an absence. You had $8,000 in a saving account in January 2015. You left it there. In 2025, that $8,000 is still $8,000 and maybe $9,200 with interest. If that $8,000 had been in a S&P $500 index fund on January 1, it would be worth approximately $28,000 today. The difference, $1,800, was never taken from you. It simply was never built. The silence of money not compounding. Or closer to now, you kept $15,000 in a saving account last year while rates were low, and S&P returned roughly 24% in those days. Not guaranteed, not a premises, but the distance between where your money was and where it could have been $3,600. Gone not be theft by stillness. The difficult things about opportunity cost is that it requires imagining a version of the world that did not happen. We are not wired for this. Loss will differ from the missed gain even when the math is identically. A $5,000 loss and a $5,000 missed return are the same number. They don't feel the same. This is not accidental. Financial products that profit from you are very happy to exit undisturbed. Doing nothing is a financial decision. It's just one that never asks for your signature. So here is what has been happening. While you are very busy working, inflation has been reducing the real value of everything you hold. Fees have been billing in your mouth, designed to feel your attention. Taxes have been claiming a portion of every transaction and every gain, every paycheck, and every hour of your money still sits. An uncountable sum of future wealth fails to exist. None of these forces require you to do anything wrong. They are brought on the responsible and the irresponsible equally. They don't care about your intentions. The people who end up with the wealth after this year are not necessarily smarter. They are not necessarily better earned in many cases. They simply understood earlier that the money was moving whether they directly it or not and choose to direct it A high yield saving account for 4.5% against 3% inflation does not make you wealthy, but it stops the backward slide. An index fund with a 0.05% expense ratio versus a managed fund at 1.2%, same market, same return, minus the gap. Save your potentially hundreds of thousands over a working life. Understanding a short-term versus long-term capital gain does not require an accountant. It requires reading one page and sitting with the discomfort of the opportunity questions. Where could this be working instead of sitting still? Turns out to be one of the more valuable questions you will ever ask yourself, not because the answer is always to invest, because the act of asking removes the illusion that stillness is natural. You get paid on Friday, $2,847, the app updates. The number sits there, briefly, and somewhere the gap between what you earn and what you have 10 years, between a paycheck and the version of your that either built something or did not, for quite system already running their calculations. That started the moment of the deposit hit. They don't stop while you sleep. The question is not they are working, the question is whether you are. No subscribe prompt, just silence.